Hi everyone. Welcome back to our financial education series. Today, we're diving into a hot topic. Will the Fed cut rates in 2024? Let's examine the current state of inflation and its implications for future rate cuts. This week, we received the Consumer Price Index, or CPI, report, which showed better than expected data. This surprise was well received following a series of unusually high inflation reports. Despite some hiccups in January and April, there was nothing that made me lean towards rising inflation. In fact, overall inflation remained stable in May. Core inflation, which excludes volatile components like energy and food, rose by 0.16%, corresponding to an annualized rate of exactly 2%. These values were lower than analysts' predictions, causing stock markets to rise this week. At the same time, the overall CPI increased by 3.3% compared to last year. It might seem like we haven't made progress on inflation since last fall, but let's dig deeper. A deeper analysis shows that the blessed shelter component related to housing costs continues to keep official inflation data high. The shelter data moves with significant delays compared to real rental markets. Remember, the shelter component, shown in dark green on the chart, is crucial for the CPI as it makes up 35% of the basket. Primary residence rents represent 8%, while the owner's equivalent rent, OER, makes up the remaining 27%. OER is an implicit rent that homeowners would theoretically pay themselves based on market rents rather than home purchase prices. Excluding the shelter component, the inflation trend is very encouraging. Overall inflation has an annualized rate of 2.8% over the last 3 months. Excluding housing, it drops to 1.7%. I believe inflation is set to decrease further. Regarding the shelter component, in Q4 2023, rent and OER had an average annualized growth of 5.4%. This slightly decreased to 5.2% in Q1 2024, and by April-May, the rate had dropped to 4.7%. For reference, the corresponding rate in 2019 was 3.6%. So, we're still far off, but much closer than a year ago. One of my favorite inflation indicators is restaurant inflation. Although not included in core CPI, it's a relevant proxy because restaurant prices combine various underlying inflation drivers: worker wages, raw material prices, including food and energy for transportation, and restaurant rental costs. This category peaked at 9% inflation in 2022, but has now dropped to 3.5%, the same level as the end of 2019. This indicates that underlying inflation is not too high. Additionally, food price inflation, supermarkets, has been flat or negative in the last 4 months, likely lowering restaurant price inflation further. Moreover, wage growth has not been rising, a stark contrast to 2022. New vehicle prices have fallen for 5 consecutive months. With no more post-COVID supply chain issues, I don't see a trend reversal. Meanwhile, private data for used cars suggests that used car prices will continue to decline, exerting downward pressure on inflation for the rest of the year. The Federal Reserve concluded its June meeting this week, deciding to maintain the current policy rate target of 5.25 to 5.5%. This was widely expected, but it was an important meeting as they updated their projections for the economy, inflation, and monetary policy. These projections, known as the dot plot, were revised from March. Members, alarmed by higher-than-expected inflation data in Q1 2024, raised their core inflation projection for the whole of 2024 from 2.6% to 2.8%. However, the major difference is on the rate cut front. They now project only one rate cut of 0.25 percentage points in 2024, compared to 3 expected in March. Yes, the Fed is being cautious, especially after previously mislabeling inflation as transitory a couple of years ago. They don't want to repeat the same mistake. The other cuts are projected for 2025 and 2026, totaling 9 cuts by 2026, translating to 2.25 percentage points, bringing the policy rate to the 3 to 3.25% range. That said, don't take the dot plots as gospel. As Fed Chair Powell emphasized, the dots are based on what Fed officials think might happen, not a prediction of what will happen. Just as the dots change from March to June, we might see opinions shift between now and September, especially if inflation continues to decrease, as I think it will. In any case, the Fed still predicts at least one cut in 2024. But there are good reasons to think we might actually see two, with the first in September followed by another in December. We'll see. One thing is certain. Once the cuts begin, we'll see a significant boost in the prices of all REIT stocks and the Russell 2000 ETF, as these are much more sensitive to monetary policy. Stay tuned. Thank you for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more financial insights. See you in the next video.